Welcome back. Conrad Wood, Head of Fixed Income at Momentum Asset Management, joins us for more Investment 360. And we've got Albert Botha, Portfolio Manager at Atlantic Asset Management, and of course still in studio, David Shapiro from Sasfin. Gentlemen, thank you very much for joining me. Albert, let's throw it down to you. In Cape Town, 5 new bonds expected to be issued this year, 2 nominal and 3 inflation linkers. Is that all we're going to see issued this year?
No, there'll be a combination of different bonds issued this year. I think the new bonds are interesting. It significantly lengthens the duration of the curve. It pushes out the maximum duration of bonds significantly. And I feel especially some of the life insurers are going to be happy with the new longer term, longer duration bonds, both on the nominal and on the effective side.
Well, how are we going to see that infrastructure spending financed in South Africa? Conrad, let's throw that to you. Of course, all eyes were on that line item in the budget yesterday.
It's a big one. We're watching it very closely in local fixed income markets because my sense is that the expectation is on local fixed income investors to fund this thing, and the numbers look chunky. If we look at our own portfolios, we're quite full of the stuff already, yet the burden keeps coming. So, you know, it's great for the economy, it's great for the productive capacity of the economy, but it has to be funded. And I think the guys are going to need to look a little bit wider than just local fixed income investors to get this thing funded.
Conrad, is there a danger if they go offshore? I mean, there's always the danger on the currency.
They've tended to want to do the thing domestically in terms of matching assets with liabilities and staying away from currency risk. There is an element of foreign currency to the expenditure and the importation of equipment, etc., that could be funded offshore. I think they're going to have no choice, but it will be interesting to see how foreign fixed income investors perceive the credit risk of the parastatals. There is a implicit government backing to most of them, but in reality, their balance sheets are very overgeared. They're going to get worse. The sovereign credit rating is on a negative outlook, and so they might have to pay up a little bit for funding, particularly in the size that they want to do if they go offshore.
Albert, let's throw this down to you. What are your thoughts on funding of that enormous infrastructure bill? David earlier saying we're looking at some 3.2 trillion. We assume that is over 3 years, about 900 billion a year.
No, I mean, I completely agree with Conrad. There's a discussion that they'll go to the Middle East this year and fund up to about 500 million in a Sukuk. They are going to have to look wider. I do, however, think that some of the measures we've seen in the budget, some of the implicit and explicit support that the government has offered to especially Sunroll this year after a lot of the controversy, and along with some of the comments we've seen that some of the tariffs and some of the pay-for-use measures that have been put in place will continue, because these things are there, they're going to have to be paid, and it's unfair to expect a country to carry all the risk when the improvements are primarily focused in a specific area.
But that means, Albert, that means additional taxes. You know, if you're going to start putting the burden, number one, we're paying already, we're paying high levels of tax. If you're going to start putting the burden on us for usage now, it just means more and more taxes. And it's okay for the very rich, you know, because they love to hit them. But what about down at the bottom? Can people afford to use what we're going to be building? You know, hospitals, whatever it is, schools, roads,
well, we
bridges,
can't afford to use the e-tolls effectively. I think that's where David's taking us. Albert, any thoughts? Or are you speechless?
Well, yeah.
Speechless down in Cape Town.
Look, I mean, these things have been built, and we're going to have to pay for them in one way or form. Either we are paying for them from taxes from the entire country, or we are paying for them with pay for use. Those are basically some of the only options we have. We can't just write off the debt. We can't, if we still have to do a lot of parastatal funding going forward, we can't set a bad precedent where some of these things are not paid for, where there's too much deferred, where some of the debt holders are asked to maybe take losses or to delay some of the payments. So at some stage we are going to have to pay for it, and I think it's good to stay with international practice that pay for use is something that can be applied.
Conrad, do you think we can pass this on to the private sector? In other words, through partnerships, and let them go try find the funding?
Yeah, I think we're going to have to. I mean, there's a very strong irony in who's going to fund this and who's going to pay for this and taxes, etc. Because From my vantage point, this is going to mean above inflationary tariff increases to fund a lot of these things. We're seeing it airports, electricity, roads. It'll spread throughout the sector. Now, above inflationary tariff increases push administered prices up. So you're going to get high inflation, which pushes rates up and the cost of borrowing up. And it's a vicious circle that's going to cost more and more to fund the thing as the inflationary impact of it does come through. Back onto the private sector, I mean, the private sector has delevered a lot. There's a lot of cash around. There must come a stage when these guys are looking for return on capital, return on equity.
They're actually going to start spending.
There's skill, there's resources there. There has to be a partnership to make this thing sustainable.
He mentioned that in the budget. If you listen to him, he mentioned the huge levels of cash that there is, and we need to get private people to, unlock that, to start investing in. Do you think he had that in mind?
I hope so. We've been disappointed with the reticence to do it on the electricity side up until now. We've seen the odd example where they're partnering with offshore private capital, but I think there's a need to partner with domestic private capital, and let's do this for the sake of increasing the productive capacity of the economy.
There's a trend, Albert, just before we take to the break, in terms of foreigners overbuying on South African bonds and underbuying on South African equities. Any further clarity on what's happening on that front?
It is an interesting trend, especially given that we've seen a lot of bond buying of South African bonds, but we've not seen a lot of South African equity buying from foreigners. We've seen, however, a lot of emerging market equity buying from the global investors. Why South Africa is excluded from this is, well, not really a puzzle. We've got lower than the average growth forecast than a lot of the other emerging markets. To a lot of extent, we don't really fit in with a lot of the other emerging markets. They don't really know where to place us. And going forward, it's going to be difficult, and we have some challenges going forward that a lot of other countries, for example, do not have. And we have some, for example, lower growth potential than some of the other big players like Brazil, China, India, and so forth. When you're an equity investor, those are some of the things that you look for. Fixed income, on the other hand, is a bit different. You look for safe havens, strong financial institutions, and South Africa has some of the strongest banks and some of the strongest financial institutions and financial regulations in the world.
Do you think then that theme is going to continue, where we see foreigners overbuying on the bond front in South Africa?
It's something we spend a lot of time analysing. Unfortunately, it's got to a stage where we've forgotten the domestic fundamentals now, and all we look at which granny in Tokyo is going to buy our bonds or which hedge fund guy in New York is going to buy bonds. So it looks set to continue. There's a wave of liquidity, again, being pumped through the Bank of Japan, the Bank of England, the Fed. And that's what's driving these inflows that in search of yield. What just frightens the living daylights out of me is when this reverses one day, if it does, and timing's going to be everything, is where do our yields need to go to clear the borrowing that still needs to happen now?
Well, haven't you got a 2-year window, as long as Bernanke leaves rates that,
at
down
zero,
and also euro in the Eurozone for 2 years. Well, at least, for 2 years you're safe. So maybe you could just hold on to your job for another 2 years.
It's a very good point. Short rates peg long rates. So if short rates are going nowhere, and the same applies in South Africa, bond yields are not going to go up in a hurry. Yeah. So we've got some time.
And Albert, also, your job not in jeopardy in the short term. We're taking a short break. We're back with more Investment 360 right after this break.